Welcome everyone to the Advisor Q&A webinar on aged care for the 20th of July 2018. So hopefully all of you can hear the audio. To access the audio, you can either call the number on the presentation and enter the access code and then get the audio pin after signing in, or you can access audio on your computer via the webinar app that you're actually looking at right now. So my name's Lara Hanson. I will be conducting the 1 hour webinar today. The webinar is based on advisor questions that have been sent to aged care steps over the last few months. So some of them might seem a little straightforward, others a little bit more complex, but it's based on the questions that advisors have been sending in to provide some sort of clarification on. So essentially, what we're going to be looking at is a variety of things. The first thing we're going to look at is questions about the family home, followed by questions about protected person and what that means as assessments go on or protected people move out, lose income support payments, all sorts of different scenarios. We're also going to revisit questions regarding low means residents, as that seems to be the one that causes the most confusion for advisors. We're also going to look at other residential aged care areas where questions have come in about particular things and items, such as filling in forms or when to update information with Centrelink or DVA. And we're also going to have a look at assessing income and assets. So some particular interesting situations about how a certain income and assets assessed for means tested fees and age pension purposes. Okay, so starting off with questions regarding the family home. Now, remembering, of course, the way the family home is assessed for aged care is dealt with under the Aged Care Act, as opposed to the treatment of the family home for social security purposes or eligibility for age pension, which is dealt with under the Social Security or Veterans Affairs Act. So just remember, when you're thinking about the family home, what are we assessing it for? Aged care fees or age pension or service pension benefits? Okay, so the first question we have with the family home, this is a question that has come up quite often, and this is what happens when a couple has entered care but on different dates. Now, as you may or may not be aware, when the Aged Care Act changed on the 1st of July 2014, there have been quite a few amendments to the Aged Care Act and the Social Security Act since that date. So the next amendment after the 1st of July 2014 essentially came into play on the 1st of December 2016. And that was a change to, the 1st of January 2016. And that was a change to the Aged Care Act and the way it assessed income from the home when calculating the means tested care fee. The next change that came into play was under the Social Security legislation, which was on the 1st of January 2017. So depending upon when someone entered care, they might have different aged care rules applying to them rather than their partner who might have gone in at a later date. So what we're going to do is have a look at what happens when there's a member of a couple and one went in when a particular set of rules applied and then one went in after those rules applied. So we're going to look at Mary and Bert. Mary moved into care in December 2016. So that means that the aged care rules and the Social Security rules that apply to her are based on her permanent entry date in December 2016. So that was before the change to the Social Security legislation on the 1st of January 2017. So this means that the rules that will be assessed towards her will be different for aged care purposes and age pension purposes than Bert, who's entering care today. So if Bert's entering care today, then it's the aged care rules that apply today and the Social Security rules that apply today. So how does this work for them as a couple? So after Bert moving into care, they decide to rent out the former home for $26,000 per annum. So what we want to know in this situation is how will the family home be assessed for Mary and Bert because they have entered care on different dates. So let's have a look at the means tested amount or care fees first, because remember this is dealt with in the Aged Care Act. So if you enter care before the 1st of January 2016, then for means testing purposes, the asset's exempt unless a protected person lives there, otherwise the cap value. If you rented out the home and you're paying some DAP or DAC, that means that rental income was exempt. However, Mary moved in after the 1st of January 2016, but before the 1st of January 2017. So for her, the asset's exempt if a protected person lives there, otherwise the cap value. So whilst Bert was at home, the cap value for her was exempt. Now that Bert has left the home and is going into care, the cap value no longer applies to her. Now, because she entered care at that date, for her means-tested care fee calculations, if the home is rented out, then any rental income is assessable when calculating her means-tested fees. So that's for essentially care fee side of things. Now, because Bert also moved into care after the 1st of January 2016, the same rules will apply to him, but this is where it gets a little bit confusing. The rules are going to apply, but through Social Security income testing first, and if that doesn't apply, then it will revert back to the Aged Care Act. Now, that might sound a little confusing at the moment, but we'll talk about how this will apply going forward on the next slide. So for the moment now, we're going to look at what happens for the home when we're looking at Centrelink DVA payments. Well, for someone who entered care before the 1st of January 2017, the asset's exempt whilst the spouse lives there. Otherwise exempt up to 2 years from the date of the last spouse leaving, or could be exempt indefinitely if the person who went into care prior to that date was renting their home and paying some DAP/DAC to their service provider. If they satisfied those conditions, that meant that any rental income received was essentially exempt whilst paying DAP and DAC. Now, that's for Social Security purposes. Not forgetting the overlap from the 1st of January 2016 to the 31st of December 2016. So during that period, it's not assessable for Social Security purpose, the rental income, but you'll notice for calculating means-tested care fees, it is, because essentially there's that overlap there. If perchance someone moves into care after the 1st of January 2017, that means the asset's exempt whilst the spouse lives there, or exempt up to 2 years from the date of the last spouse leaving. Now, you'll note there that for those people, there is no ability to extend the exemption indefinitely past that 2-year date, purely because that's when the Social Security rules changed on the 1st of January 2017. So that change took away the ability to extend that exemption indefinitely if the home was being rented and a DAP was being paid to the service provider. That also meant that if you didn't have the home exemption, then rental income exemption was also lost, which meant that any rental income is assessable when calculating age pension. So once again, having a think of that difference of overlap, there could be a different treatment for rental income for means-tested fees compared to age pension fees, depending upon when the person entered care. So applying this to Mary and Bert. So let's have a look at what happens for them as a couple. Now, the Aged Care Act is always looking at the individual in care. So they're looking at the date that the individual entered aged care. So for Mary and Bert, because they entered care after the 1st of July 2014, albeit at different dates, the cap value of the home is going to apply per person. Because they're saying that the moment the home is no longer occupied by a protected person, then the cap value of the home will count per person when determining their means tested amount. Now, the income assessment, if they're rented it out, then that's going to have a look at the date that they entered care. So in this particular instance, what we find is that they've entered care at different places. So for Mary, she's entered care between the 1st of January 2016 and the 31st of December 2016. So that means that any rental income that's assessed towards her is assessed under the Aged Care Act. So that means that half of the rental income in this sense, because that's half of hers, essentially will be assessed to her as an individual under the Aged Care Act. Now, we know that when it comes to assessing the means tested amount, that we're also looking at what's assessable income under the Centrelink income test. Now, if we think about Bert's gone into care today, which means that his share of rental income is going to be assessed under the income test for Centrelink purposes. So in a way, there's going to be a transfer of income that's accessible towards him to Mary, albeit in a small way, but we'll talk about that in a moment. So let's go over to the Centrelink side. So for this particular case, the asset side of the home, what we're saying here is that the exemption that's going to apply is 2 years from the date of the last spouse leaving or Mary's death. Because remember, Mary entered care before the 1st of January 2017. So she has the ability to extend the exemption on the home past the 2-year period if she's renting the home and if she is paying a DAP to her service provider. Now, does this exemption apply to Bert? Yes, it does, because under Centrelink legislation, we're looking at them as a couple. Now, that is different, remember, from the aged care legislation, which is looking at them as an individual being assessed per person. So for Centrelink side of things, because Mary can satisfy the exemption on essentially, extending that exemption indefinitely if the home is rented and she's paying a DAP, that means that the home exemption for Bert will also apply for the same time period. So he won't have to worry about the home becoming accessible in 2 years' time for him, because the exemption for a couple applies to both of them. So what happens on the income side then? Well, we know that for Mary, if she is paying a DAP to her service provider because she entered care before the 1st of January 2017, then her share of rental income is exempt when calculating age pension benefits. But not forgetting, of course, it is accessible for her as an individual under the Aged Care Act when calculating her means tested fee. So really important to note there. Now for Bert, what's happening here is because he's entered care on the 1st of January 2017, essentially what's happening here is that income would be accessible for him, but Mary has the exemption. So remember, as a couple, for Centrelink purposes, if one member of a couple gets the exemption, so does the other. So this means that any income for age pension purposes is exempt for both of them if the home is rented and Mary is paying a DAP. So it's really important for those clients who entered care before the 1st of January 2017, if they're a member of a couple, not to pay the RAD or RAC in full for the person who's already in care prior to that date. Because if that is done, then they can't get the exemption to apply to the person who goes in today, because they're not eligible for the exemption if they're paying a DAP or DAC to their service provider. So the focus in this case is definitely on Mary and the exemption belonging to Mary. However, the interesting thing with this one is that we then go back to the Aged Care Act, and the Aged Care Act is saying, yes, although Bert and Mary, your rental income is exempt for age pension purposes, it's both going to be assessed because of the date that you entered care. So it's just really having a think about, we start with what's accessible under the income test for Social Security, then we move to the Aged Care Act, and then add on what's accessible based on the permanent entry date. So just a good point to note there, that we can definitely get some Centrelink concessions for Bert purely because Mary is eligible. Okay, so the next couple of questions we're going to talk about is the principal resident exemption, because things can change, and there's some general situations that might mean that the principal resident exemption is actually lost before the exemption period expires, or alternatively it can't be extended. So let's have a look at Gary. So Gary is single and he lives alone. So he has a home worth $800,000 and he has cash of $50,000. Now, quite often what family members like to do in this situation is that they do like property. But unfortunately for Gary, he's not assessed as a low means person. So they're looking at releasing some of the equity from the home to be able to fund his costs going forward or make a RAD payment. So quite often what family members do is sell the home and then buy another one after Gary has entered permanent care, and think that the principal resident exemption still applies to that home. Now, given this situation, if he was to do this arrangement, so he moves into care, his family sells the home and then buys another home after he's become permanent, then how will this new home be assessed? Can we still get that principal resident exemption on that home? So the answer to this one is the principal resident exemption is actually lost if the home is sold during the exemption period, because remember, the home is exempt whilst you're not there. Now, if you're going into aged care, you're actually permanent somewhere else. So if you were not actually in aged care and decided to sell your home during the principal resident exemption, then different rules might apply to you. But we're talking about Gary, who's already gone into permanent care. So in this case, he actually loses that principal resident exemption because it's sold during the exemption period. This means that any proceeds received are immediately assessed under the income and asset test under the Social Security rules, which of course then flows through to aged care fees. Now, the reason why this happens is any new property purchase can't actually satisfy the exemption to be granted the principal resident exemption. And that's because the property was not the former home of the person. So to be granted a principal resident exemption, the person has to have lived there and have been their former home. Now, any new home that is bought by the children is not the former home. Gary has never lived there, so therefore the exemption cannot apply to any new property that was purchased because it was not his former home, so therefore it becomes fully assessable as any other property, such as an investment property would be. Now, the slight twist to this, if Gary was married, then the exemption would continue to apply as he would be a member of a couple. Because remember, when we're talking about exemptions for Centrelink, if one member of a couple gets the exemption, then so do both of them. So that's why if he was a member of a couple, he could downsize the home and buy a new house for his wife, and then essentially the principal resident exemption would continue to apply to that home. They are a couple for Centrelink purposes, even though they're separated due to illness, but they still are a couple, and his spouse would get the exemption, so therefore it will extend to him. The next question is also about the principal resident exemption. So in this case, we have Keith and Mary, who are a married couple. They own their home worth $1 million. Now, what they decide to do is purchase a retirement village unit for $500,000 using some cash that they have. They're going to move in and they're going to retain their previous home and leave it vacant. So this happens quite a lot where couples like to downsize into a retirement village unit, but they also like to keep their former home. Now, 12 months later, they both need to move into aged care. Now, at this point, they have $100,000 in cash. They still have their $1 million home, which has been left vacant, and the exit value of the retirement village at that point is $450,000. So the question we have here is, how is the retirement village unit and the previous home assessed for Centrelink and aged care fee purposes? So really what we're looking at is, well, how is the principal resident exemption applying in this situation? Now, quite a lot of couples get a bit of a rude shock when they do this type of arrangement and realise that the principal resident exemption might actually apply to the property that's worth the less, which means it might impact what their aged care fees and age pension entitlements are. So let's have a look. So they've got two homes. So which one will the principal resident exemption apply to? So in this case, it will apply to the home in which they spend the most amount of time if they're still living in both. Now, in this particular situation, they're living full-time in the retirement village unit, so that's the one they spend the most amount of time, so the principal resident exemption will apply to the retirement village unit. Now, if perchance they are spent 50-50 in each, which is probably unlikely because the retirement village contract is telling you that you really need to live there, but let's just say that they did live an equal amount of time in their former home and their new retirement village unit, then the exemption will apply to the most expensive home. Now, if they do spread the time across, then they're obviously going to have to provide some documentation to prove which residents the principal resident exemption should apply to. Now, as John and Mary spend most of their time, oh, sorry, that should be Keith and Mary. Mary's hooked up with John from question number 2. So in this case, Keith and Mary spend all of their time in the retirement village unit. So this will be the property that the principal resident exemption applies to. Now, if a client does actually, downsize and into a retirement village unit and keeps their former home, they must notify Centrelink of the change in their circumstances. Quite often they don't. So this obviously is a case of Centrelink fraud because they haven't updated their financial information. So you could imagine with Keith and Mary, if they hadn't updated their information, essentially they'd still be receiving an age pension, which they would not be entitled to if they'd updated and said that the retirement village was now their principal residence. And that's because the value of their former home is actually worth $1 million. So this can cause a bit of an issue with clients who are wishing to downsize, and it might impact what their age pension entitlements are after the change in residence, purely because they need to apply that exemption to one of the residences. So in this case, the previous home worth $1 million is fully accessible for age pension benefits and their means tested care fees once they go into care. So let's have a look at how this would look like. So we're doing the outcome of the initial SA 457 assessment. So principal resident exemption, let's have a look. So they remain, if they had remained in their former home, so we're assuming here that they did not purchase the retirement village, that they decided to stay where they are, and they have $600,000 in cash. So that means they've only got one residence, so that applies to the $1 million home. So what we can do with this particular residence is now say, okay, well, for the means tested care fee, it's going to be the cap value per person that's going to count, but it's going to be exempt for Centrelink for 2 years after the date of the last spouse entering care. Now, if they had retained their situation like this, they could have decided to leave the home vacant or rent it out or sell it after they've gone into aged care. Now, if they had decided to leave it vacant or rent, just to point out that land tax might apply. Now, their position on day one, just assuming that the house is left vacant, they would have to pay a means tested fee of $10.07 per day each. Now, that would apply until the home would be sold. So that's really based on the cap value and each and the $600,000 in cash. Now, as we said for Centrelink, it is exempt for 2 years, but now that they're going into aged care, separated due to illness, their age pension entitlements would just be over $30,000. So not a bad outcome for them if they were to retain their former home and stay where they are. Now, if they had purchased the retirement village using that money in cash, now remember they were moving in and leaving the former home and leaving it empty, and it's now 12 months later. At that point, the unit's worth $450,000 after exit fees. They've got a former home worth $1 million and $100,000 sitting in cash. Now, because they've bought a retirement village, now that they're vacating it to go into care, it's probably 99.9% certainty they're going to have to sell once vacated. So we will have to check the details of the retirement village unit, but essentially, they're probably going to have to sell that down. Now, because the former home in this case would be assessed as an investment property, they can't switch the principal resident exemption back to that property once the retirement village unit has sold. Because remember, it's the property that they've spent the most time in, and that's the retirement village unit. So in this case, the cap value per person still of the unit of $450,000 is going to count when calculating their aged care fees. But because the full $1 million value of the property and the $100,000 in cash is assessable, that means that their means tested fee will be $23.80 per day each. Now, once they sell the retirement village unit, just assuming that they put all the money in cash, then their means tested fee would increase to $27.09 per day once it was sold. Now, if they had updated their information with Centrelink, then the retirement village unit, which is the one that gets the exemption, still gets the exemption for 2 years. And as we said, it doesn't switch back to the former home once the unit is sold. It only applies to the residence, so the one that was accessible at the time. Now, based on this, they're actually not eligible for the age pension. However, depending upon how they actually pay for their RADs after they move into care, they might become eligible as the RADs are exempt. So I think the purpose of this question is really to have a chat to clients about what happens if they want to downsize into a retirement village unit and keep their former home. So they understand how the principal resident exemption applies whilst obviously they're living in the retirement village unit and how that might impact their age pension benefits. Now we can see in the case of Keith and Mary that if they had downsized, then the outcome would be a little bit more detrimental on the fees that they would be able to would have to pay for aged care, purely because they wouldn't be able to retain the home, because generally retirement village you have to sell. They couldn't have rented it out, and they can't leave it sitting there vacant either. So it's just sort of having those conversations with clients so they're fully aware of the circumstances of what happens if they want to downsize and retain their former home. Okay, so next question. We've got Larissa. She's selling the former home in this case. So she's a widow, lives alone. Her home is worth around $1.2 million and she has cash of $70,000. Now she's a full age pensioner, so based on these circumstances, she's not low means, so she's going to have to pay the advertised RAD, which is $300,000. So her family are looking to sell her home and they don't want to rent it out. Now this is happening quite a lot because of the changes to the Centrelink exemptions on the 1st of January 2017. So that means there's no longer any concessions available on extending the exemption on the home past the 2-year period if the home was rented out, and that also meant that there was no exemptions on rental income being exempt from the income test either. So now the whole strategy of maybe renting the house out might just fall in the too hard basket because of those concessions are no longer available. So in this particular case, the family really don't want to rent it out. They are looking to sell the home, but the question is here is, well, should we sell it now or should we sell it when the 2-year exemption expires, since she can't extend the exemption beyond that period? So the question is, what would the impact on her aged pension and aged care fees be if she were to sell now and pay the RAD in full versus in 2 years' time when the principal resident exemption expires? Okay, so let's have a look at that. Okay, so if she sells now, and remembering we're assuming that she's going to pay the RAD in full with the proceeds, it would mean that her means tested fee would be $59.77 per day, but that would decrease over time because she has a cash flow shortfall. So as that's reducing her assets, then obviously her fee will reduce. Now, based on this circumstance, her means tested fee, she'll reach her lifetime cap in about 3.5 years. Now, once she sells the home, even if she does pay the RAD in full, she's no longer eligible for the age pension. So this can be a little bit of a rude shock for some of our age pensioners, especially Louise in this situation, who only has $70,000 in the bank and has probably been a full age pensioner for quite some time. So we can look at strategies then to say, well, we have got that 2-year exemption period where the home's not accessible. So would it be worthwhile selling in 2 years' time and leaving vacant until then, remember, because the family don't want to rent it out because there's no rental concessions there available anymore. So what would happen if we just held on to it for 2 years and then sold it when the exemption period expired? Now, this might seem like a, rather, interesting strategy to talk about with clients, because remember, in 2 years' time, if we keep the home, then the full value of the home is going to count towards the asset test. So essentially, Louise would lose her pension in 2 years' time if she retained her home. However, the life expectancy of someone in care is usually around 2 years. So it's this whole thing of, well, yes, the 2-year exemption does expire, but it might not be an issue given the expected life expectancy anyway. So what if we held on to the home for 2 years and then sold it when the exemption period did expire? Well, today our means tested fee would be $1.92. So that would be based on the cap value of the home and the $70,000 she's got in the bank. So obviously a lot lower than if she was to sell the home where the entire proceeds would count, regardless of what she actually did with the proceeds when determining that fee. Now, in 2 years' time, when she sold the home, because remember, the whole lot's going to count at that point. So with the proceeds, $58.66 per day will become her means tested fee in 2 years' time when the home is sold. Now, this means she'll reach her lifetime cap in fees in approximately 5.5 years. Now, the benefits of this one is that she's actually eligible for the full age pension for the next 2 years that she's in care. Once she sells the home in 2 years' time, she's not eligible anymore, even if the RAD is paid in full, because the proceeds available after that are still above the non-homeowner asset test threshold. So that does provide a benefit in that she can obviously maintain the age pension for the next 2 years. But remember, during this time, she's only got $70,000 in the bank. So is that enough to fund her fees? Because she's not paying any RADs. She'll only have to be able to pay a DAP. Is that enough to cover her fees in the next 2 years' time? So that's a really important consideration when having a look at these types of strategies. So let's have a look. Okay, so on the graphs, option 1 is essentially selling now. So from a cash flow perspective, we don't have an issue because we do have all the surplus proceeds. We can see cash flow improving in around 2.5 years' time, actually around 3, and that's because she's reaching her lifetime cap in means tested care fees. So let's have a look at option 2. So option 2 is we're going to hold on to the home for 2 years and then sell when the exemption period expires. So remember, we've got $70,000 sitting in the bank. So the cash flow shortfall for the next 2 years is just over $22,000 in each year. So she has more than enough of funds sitting in the bank of that $70,000 to cover the cash flow shortfall in the 2 years whilst awaiting sale. So this strategy would work out for her in that she does have enough to fund her fees whilst awaiting that sale period of 2 years. Once she sells the home, we can see not much changes, except this time she's now got more proceeds available to fund that cash flow shortfall going forward because the proceeds after paying the RAD are now sitting there in liquid investments. So no issue there from cash flow wise. Now, from a projected net asset perspective, what does it look like? Okay, so if she was to sell now, which is option 1, we can see, yes, everything's nice and fine, but we're essentially selling a growth asset right now, losing our age pension and then funding our expenses from our own income sources. So not only are we selling the growth asset, we're investing in non-growth assets, which is the RAD and the cash and term deposits she might have invested the surplus proceeds. So once again, very doable, but let's have a look at what happens if she retained the home, which is the growth asset, for 2 years. So for that 2-year period, while she retains the home, she's going to be a full age pensioner. So in a way, that could, in a way, be rent, even though it's not, but we're just saying that's a return that she's getting by keeping her home for that 2-year period. So not only is she getting the growth, she's getting the return in that she's able to keep her age pension. So those two factors combined together means that keeping the home is actually quite a good strategy for that 2-year period. So at the end of 2 years, we can see the difference in the asset value is around $60,000. So that's the benefit for her of keeping the home. And remember, vacant, we're not renting it out, we're just leaving it vacant for that 2-year period and still getting the age pension and still retaining the growth asset for that period. Now, once she sells at that point in time, we can see that assets start to go down, but that's just a function of her cash flow deficit, which you can see in years 3, 4, and 5 above, which is now drawing from her non-growth investments. Because remember, when the house is sold, we're investing into the RAD and then cash and term deposits at that time. So that's something that you might want to have a think about when having a chat to your clients, where renting the home might not be an option, but they're also worried about selling the home right now due to the high value and losing the age pension. So that could be something that is considered for those clients. Now, remembering, of course, it's not as suitable for everyone, because if they don't have the ability to fund the cash flow shortfall during the exemption period, then it might not be appropriate. You need to make sure that you do include costs to maintain the home, because obviously cash flow can be overstated if this doesn't happen. Now, remembering there also might be insurance issues if left vacant, so you'll need to check with the insurance provider to make sure that coverage is available due to vacancy of the home. Once again, we're looking at that whole life expectancy issue of, well, it's 2 years' time. So yes, sell in 2 years' time, but if we retained at that point in time, we know that Louise in this case would have lost her age pension, but she still would have had another $25,000 sitting in a bank account to fund her shortfall, during projection year 3. But at some stage, if she didn't sell at the end of the exemption period, she would probably have to sell some stage after that if her life expectancy was actually longer than 2 years. Estate issues could be another one. Is the home left to someone and has the person got capacity to change their will? Because remember, if it's sold and funds are paid towards the RAD, then an estate asset is no longer available and the RAD goes back to the estate as cash and is distributed in accordance with the way other cash assets are. So whether renting is an option during the 2-year time period, just remember any rental income is assessable. So if Louise did rent her home out, she could actually lose part of her pension because rental income is assessable. The other option might be is to retain the home at the 2-year mark and rent it out at that point when the exemption is lost. So let's not worry about renting it out right now, but when the exemption is lost and the age pension is lost, then we could actually look at renting the home at that point to replace lost income. So lots of things to consider there with the home. Okay, so now we're looking at protected person questions. So we often get this because remember, protected people under the Aged Care Act are looking at exempting the family home or the cap value of the home for aged care purposes. But unfortunately, there's a different definition of a protected person under the Aged Care Act as there is for Social Security legislation. So what is the protected person differences for aged care fees and for Centrelink purposes? Okay, so for aged care, a protected person is a spouse or a carer who's lived in the home for at least 2 years, who's providing caring duties and who's eligible for an income support payment at the time of the MTA assessment. So they don't have to be receiving carer payment, which is the income support payment, but it's just saying that if you applied at the date that the person went into care, would you actually be eligible to receive it? Close relative is also a protected person, so they have to have lived in the home for 5 years and eligible for an income support payment at the time of the MTA assessment. So the important thing to note is that for the carer and the close relative is they don't have to be eligible for the income support payment for the entire period. So for carer 2 years, they only have to approve that they're eligible at the time of the MTA assessment. Same thing with the close relative, they don't have to be receiving the income support payment for 5 years, just at the time of the MTA assessment. Okay, so for Centrelink purposes, the spouse is definitely a protected person, but unfortunately a carer and a close relative is not. So that means that whilst the spouse is occupying the home for Centrelink purposes, the home is exempt indefinitely. But if the home is occupied by a carer or a close relative who is a protected person under the Aged Care Act, Then for Centrelink purposes, then the home is only exempt for 2 years because that carer and close relative do not satisfy protected person for Centrelink purposes. So at the end of 2 years, the principal resident exemption will be lost for the client, and the full market value of the home at that time will be assessed towards the Centrelink asset test. Now, the important thing to note that the Aged Care Act says that for the purposes of calculating aged care fees, only the cap value will ever count, regardless of what is assessed on the Centrelink side. So, for example, if there wasn't a protected person in the house, then it's the cap value on the aged care side, and then for 2 years it's 0 on the Centrelink side, and then the full market value on the Centrelink side. Then what happens when the full market value kicks in? The cap value will only ever count on the aged care fee side. So if the home is occupied by a protected person, a carer or a close relative, that means that no cap value will count on the aged care fee side. And then when the full value of the home counts for Centrelink purposes in 2 years' time, then essentially no value will count towards calculating the aged care fee because the home value of the home is exempt above the limit that applies for aged care purposes. So looking at these types of rules, let's look at what happens when people might lose their protected person status. So we have Peter. He moved into permanent care as a fully supported low means resident. His wife Jenny remains living in their home. After a few months, Jenny decides to go live with their son Peter Jr. So their home is worth $400,000, contents of $5,000 and cash of $75,000. So how will Jenny's move impact Peter's aged care fees? Well, unfortunately, if Jenny as a spouse leaves the family home and goes to live with her son, which this does happen quite often, then she's losing her status as a protected person because she's no longer remaining in the home. So this means that the cap value of $165,271.20 will now be assessable when determining Peter's fees. Now, because he's a low means resident, what he pays is reassessed every quarter, but is capped at the accommodation supplement that belongs to his service provider. Now, the maximum accommodation supplement is $56.14, which based on an MPIR of 5.96% is an equivalent lump sum rack of $343,872. If perchance Jenny did move out, then Peter would also have to pay a means tested fee of $1.10 per day. So something that seemed quite an innocent move in that Jenny didn't want to stay in the home anymore by herself because she was lonely or wasn't managing and wanted to go and live with the son means that she's lost the protected person status for aged care fee calculations for Peter. Now, that means his fees will go up. Now, in this particular situation, they don't have much money outside of the home. So it's about, well, how are we going to fund the $343,000 rack? So it's going to be a very interesting situation for them. Now, from an aged pension perspective, now she has to decide or notify Centrelink as to her intentions with the home, because remember, you can be absent from the home for 12 months from a non-care situation, or absent for up to 2 years for a care situation. So Jenny could argue that she's moved in with Peter Jr. to be in a care situation, so it's 2 years from the date of the last spouse leaving. If she can't argue that situation, then it's 12 months that she's got whilst the home is exempt when calculating their age pension benefits. But either way, just think about what sort of, what are we looking at? Aged care fees, Aged Care Act, or are we looking at Social Security rules, which is obviously the Social Security Act. Okay, so we're now going to look at losing protected person status again. So now we're going to assume that Larissa's home from question 4 was occupied by her son Dennis, who had lived there for more than 5 years and received the age pension. So that means he satisfied the definition of being a protected person. So at permanent entry, she was actually assessed as being a low means resident with a DAC of $10.34 per day. Now, her service provider has an accommodation supplement of $36.59 per day. So the question is what would happen if Larissa were to sell her home and buy another worth $800,000 after moving into care? Would Dennis still retain his protected person status in the new home? So this was based on a case where the person was in care and they did have a rather expensive house, but the family were wanting to sell it down and still buy a home for the person or the protected person in the home because they were not self-sufficient and needed accommodation costs or accommodation provided for them. So the whole idea with this one is that, well, what happens? How is that new home assessed, when going into care? Now, in this case, Dennis will lose his protected person status, as this status can only apply to a home that he resides in if the person who is or was a homeowner at the time. Now, we saw from one of the earlier questions that if someone was to sell their home after entering permanent care and to buy another, then they couldn't actually apply the principal resident exemption to that home because they couldn't be a homeowner in a home that they'd never lived in before. So same thing applies here. It's not their former home. They were not a homeowner in that home because they never resided in it. So it's really important to note here that if this was to happen, then any new home purchase we know is fully accessible for Centrelink purposes, but it also means that it's going to be fully accessible for aged care purposes as well, because it's not a former home where the cap value applies. It's a new home which is assessed 100% under the Centrelink asset test, so therefore it's 100% assessed under the aged care rules. So Dennis will lose his protected person status because it can't apply to any new home purchase. It can only apply to the former home when the person was a homeowner at the time. So the full value of the home would be assessed under the asset test for age pension and aged care fee purposes, which means her DAC will increase to the accommodation supplement of the service provider, which is $36.59, which is an equivalent RAC of around $224,000. So that's a bit painful, but what's even more painful is because the whole amount is assessed, she's going to have to start paying a means tested fee of $54.28 per day. Now, this is going to be the same whether she pays the DAC only or the RAC in full. And that's purely because there's no income coming in from the home because it's occupied by Dennis. So no income component there because income's under the threshold. So that means that that amount won't change even if the funds or the residual funds are used to pay the RAC in full, because she has to have an income component for the means tested fee to change for RAC payments. Okay, question 9 is absence from the former home. So in this particular case, Jeff owned his own home and his daughter Barbara has always lived in the home and received Centrelink DSP. 3 years ago, Jeff moved in with his son David and left Barbara living in the home. So Jeff now needs to enter care. So does Barbara satisfy the definition of a protected person? So in this case, the answer is no. And this is because Jeff is no longer a homeowner because any applicable exemption period that could have applied to him and have him assessed as a homeowner has long since expired. So remember, it's 12 months you can be absent from your home in a non-care situation and 2 years to be in a care situation. So even if we argued that Jeff moved in with his son to be in a care situation, it's now 3 years later. So 12 months ago, the principal resident exemption would have been lost and the full value of the home would have been assessed under the asset test for Centrelink purposes. At this stage, Jeff also would have been assessed as a non-homeowner, and when we're looking at the protected person, it can only apply to the person who is or was a homeowner at the time. Now, Jeff has no longer been assessed as a homeowner and he has not been a homeowner for 12 months. So unfortunately, the full value of the home will be assessed here, not the cap value. And not only is the full value assessed for aged care fees, it will also be assessed for age pension purposes. Now, a lot of the time, these types of clients don't update a change in their residence with Centrelink. So once again, might get a bit of a rude shock when they realise that the principal resident exemption has expired when they go into aged care. Now, in this case, not only has it expired, but it meant that Barbara, who's living in the home, who obviously is reliant on the home for accommodation and receiving a DSP, is not a protected person, which means that, you know, as I said, there's no status applying there, and the whole value of the home is going to be assessed when working out what Jeff's fees are. Okay, so now we're going to have a look at low means resident questions. So quite often we get questions about, well, is low means forever? And it's interesting, you know, sometimes yes, sometimes no. So let's have a look at the first question. So if a client enters care as a standard resident, so that means they're paying a RAD, but at some stage can no longer afford their fees because their means have reduced, will they become a low means resident? So the answer to that question is no, not while they're at their current service provider. So whilst they're there, they have to pay the fees that they're contracted to pay if they haven't been assessed as a low means person. Now, if they come into that situation, there's essentially a couple of things they could do is to say, all right, well, I can't pay for the RAD anymore. So I could move to another service provider who has a different RAC, not RAC as in residential aged care ID number, and they complete a new SA 457 form showing that they're low means upon entry into the new service. So every time someone goes into a new service provider, they do need to fill in a new SA 457 form, and that form is going to determine whether they're a RAD payer or a low means person for that particular service provider. So that's one thing that they could do, is to move service providers. So that's an interesting thing there. Alternatively, depending upon their circumstances, the client could stay where they are and apply for financial hardship with their fees once their assets are below certain thresholds. Now, we did deal with financial hardship in our previous Q&A webinar, so we're not going into the details here, but it's just something to consider that, if someone legitimately has eroded away their assets in paying for their fees, then they could become low means if they move to another service provider, or they could apply for financial hardship where they are, which essentially is saying low means, but due to a financial hardship determination. So it's worthwhile investigating both of those options if that happens to a client. Now, just remembering, of course, that assessable assets do include any payments made towards the RAD. So that's a really important thing to note, that financial hardship obviously can't be granted if a RAD payment above thresholds have been made. So next question, if a client enters care as a low means resident, that is a RAC payer, and moves to a new service provider, will they retain their low means status? So this kind of situation happens a bit with couples when someone's gone into one service provider as a low means resident, and then their partner needs to go in, but there's no space at the existing service provider, so the partner goes into another service provider, and then what happens is that the person who went in first is now going to transfer across to be with their partner in the new service provider. So this happens quite often. So will, in this case, a low means resident become a standard RAD payer if they were to transfer to a new facility? Okay, well, this one's going to really depend upon the initial entry date and the level of income and assets at the date of the move. So first question we have, if they entered care on or after the 1st of July 2014, then every time they move to a new service provider, they need to fill out a new SA 457 form, and that outcome will determine whether they're low means or a standard RAD payer at that service provider. So if they're currently a low means resident and means they move to a new service provider and the outcome of that form says that they're a RAD payer, then they will lose their low means status. So that's important to know. Now, if they entered care before the 1st of July 2014, things can be a little bit different here. Because if they elect to have the new fee and payment arrangements apply effective from the 1st of July 2014, then they will be assessed as we just explained. So that means they'll fill out the SA 457 form, and the outcome of that will determine whether they're low means or a standard RAD payer. However, if they continue to be assessed under the pre-July 2014 rules, then they will continue to be assessed as low means, even though the terminology before that date was fully supported or concessional resident. So there's just a slight change in terminology. So that way, if a service provider takes on a pre-July 2014 resident and the new rules do not apply, then they accept them as is. So that does not change. So that's a really important thing to know. So if you are a pre-2014 resident and you do want to switch to the new rules if moving to a new facility, then what's the process? Now, the important thing to note with this is it is the transferring resident's choice of whether or not they want to elect to have the new rules apply. Even though it's their choice, the service provider might dictate their choice by saying we're only accepting residents who are being assessed under the new rules at the moment. So if you want to be with your partner, you're going to have to elect to have the new fee and payment arrangements as of 1st of July 2014 apply to you. Now that process is fairly rigid to have those new fee arrangements apply, mainly because the new fee arrangements generally make things more expensive for a pre-July 2014 client, if they elect to apply them going forward. So there is a process purely because of the change in fees and structure. So the first thing we have to do is a place is offered to the resident and they accept the offer under the new rules. So remember, it's their choice, but the facility might dictate that they only have a new rule spot available. A new resident agreement is drawn up based on the choice the resident makes. Now, the next two steps are really important. Both of these have to take place before the move to the new aged care provider. So the new aged care provider must give the new resident a copy of the new arrangements for aged care from 1 July 2014 and written information advising them that if they choose to apply the new rules, then that will result in a change in their fee and payment. So they understand that what they pay now might change significantly if they were to move facilities and have the new rules apply. So that's the information that the service provider has to provide. The resident, before the move again, must complete the continuing care recipient opting into the new aged care arrangement form from July 1, 2014 and provide it to the new service provider before the move. Now, the reason why they have to do this is they've got to check boxes saying that the service provider has provided them all the information that's required in step 3 and that they understand that there will be a change to their fee arrangements. Then once the resident goes to the new service provider, they will complete a new aged care entry record, attach the completed AC022 form and send it to the Department of Health. The resident then has to complete the SA457 form. So this is just a little screenshot of the AC022 form where the question 5 shows that has your new provider given you written information advising that you choose to be subject to the new fee arrangement? So the answer is yes. And has your new provider given you a copy of the new fee arrangements? Yes. So the important thing to know, if you select no to either of those questions, then your choice to be subjected to the new fee arrangements will not be accepted. So that's why it's sort of saying that this is what has to be done before the move, because this cannot be this election cannot be made after the move, because you have to be aware of all the changes circumstances beforehand, so you're willing to accept those changes and you're aware of them. But if you've already moved, then it's too late, because all of this happens to happen before the move. Now, if there was a problem, then essentially if you leave the aged care system for more than 28 days, then you can come back in and the new fee arrangements will automatically apply to you. So obviously we want to make sure we get this right if this is going to be the case. Okay, so other residential aged care questions. So we get this one quite a lot, is when might an SA457 form not be needed? So this is for our self-funded people who have quite a lot of assets. So we have Jack, who has 2 million of financial assets and a home worth 1 million. So if we calculate his MTA, it's $211 a day. Sorry, his MTA is $211 a day, which means his means tested fee is just under $155. Now, the important thing to note in this is that what he pays is always the lower of his means tested fee or the ACFI subsidy that applies to him, which is up to $248.75 per day. So that's what we're looking at here. So the question is should Jack fill in the form? Okay, so as we said, cost of care is lower than ACFI or means tested fee. So how do we know what the ACFI is? Well, this is really difficult in that it's a process that's followed at the aged care provider, that they complete a care assessment, which takes 28 days to determine what ACFI subsidy they're going to apply for the resident. Then the SA457 outcome reduces the subsidy payable by the government towards that service provider to look after, the person. So if there's no SA457 form, then the MTF charge is the full cost of ACFI until you hit the annual cap. So in this case, for Jack, should he fill it in or not? Now, if his ACFI is less than $154 a day, then there's no benefit in completing the form, as the cost of care is always going to be capped at the ACFI either way, because essentially you can't be asked to pay any more than what it costs to take care of you. If the ACFI is more than that, then essentially he will pay his means tested fee of the $155 per day until he reaches the annual cap, and then it will reduce to zero to that point where the government will then pick up the full subsidy, the full ACFI subsidy payment. But the interesting thing with this one is that we don't know what the ACFI is. The ACFI could be up to $248.75 per day. So what do we do for someone like Jack? Well, in this case, because we don't know and his calculated means tested fee is lower than the maximum ACFI of $248.75, then I would say fill in the form, because you just never know your luck in this particular case. If you don't fill in the form, however, you still get the daily, annual and lifetime caps that will apply to the calculation. Okay, so let's just assume that Jack's ACFI is $145.47 per day, and this is based on a medium classification. So his ACFI is lower than his means tested fee calculation of $154. So this means it's going to be capped at his ACFI of $145. So he's going to pay that for 185 days. Then he'll reach his annual cap of just under $27,000. So from that point onwards, he'll pay no means tested fee for the next 180 days, but he'll still have to pay other fees. Now that means tested fee will recommence at his care anniversary. Now, even though it's set at ACFI, just remember his ACFI could increase if his care needs increase. So that's based on an assessment of care on any given day. Assume that Jack's ACFI was actually $216 per day based on a high classification. So if Jack fills in the SA 457 form, then he's only going to pay a means tested fee of $154 a day for 174 days. Then it'll drop to zero for the remaining 191 days as the government will pick up the full cost of his ACFI. And his means tested fee will then recommence in his anniversary year. So he's going to reach his annual cap of just under $27,000. If he doesn't fill it in, he's going to pay his actual cost of care, because remember he's waiving his right to government help, of $216 a day for the next 125 days. So once he reaches his annual cap of just under $27,000, he's going to pay no means tested fee for the next 240 days. So as you can see, over the year, under both circumstances, whether he fills the form in or not, he's still going to reach his annual cap. So why do it? Okay, so for Jack, his benefits are, from an admin point of view, the service provider might say filling in the SA 457 form is part of our admin policy. So here you go, fill it out. You can fill out the form and opt out on the form that you don't want to provide your information and waive your right to government support. Or if you don't fill in the form, you get 2 reminders before you get a 3rd letter saying that your means not disclosed, which is a 63-day process. So it just might be purely from an admin perspective that, might be beneficial filling it in. Now, from an earning perspective, even though we're reaching the annual cap in both circumstances, if we fill in the form and pay the lower means tested fee, that means we're retaining our investments for longer because we're funding a smaller fee of $154 compared to $216. So it does mean that we do have the potential of higher earnings because we're paying a lower fee for longer as opposed to a higher fee for shorter. The other benefit might be in the year that he passes away, because remember there's a difference of around $65 in the 2 fees. Oh, sorry, well, actually I've already got it there, sorry, maths in my head. So just under $62 is a potential saving, but that's only if he passes away before day 125, where he would have reached his annual cap if he hadn't filled the form in. So having those conversations with the client to say, for Jack, there are some benefits. You might not actually receive all of the benefits, but it's very subjective as to whether you are or not. So let's just fill it in and see how we go. Here's a little table to show when it's not beneficial. So Jack came in between the 3rd tier, which was between 1.3 million to about 3.1 million. But if a particular client has over 3 million in fees, this means that their means tested fee will be the actual maximum ACFI of $248.75. So there's no point filling in the form if they have assessable assets over that limit. Now, in this particular case, that included the cap value of the home and financial investments. But just remember, for those super rich clients, you still might want to fill in the form and just opt out on the form so they're not harassed by Centrelink, 3 times to fill in a form that they don't want to. So that might just be the benefit of doing it. Okay, the $48,500 rule. So this one we get quite a bit, and there's a little bit of confusion, mainly coming from service providers. So in this case, Manny is single and he lives alone, and he has a home worth $300,000 and has $200,000 in a bank account. Manny now needs to enter aged care with a rate of $400,000. So this question, does a resident always have to be left with $48,500, which is the minimum permissive asset value in assets after the RAD is paid, or RACI flow means? So this $48,000 rule only applies to payments made in the first 28 days in care, and only if the resident has provided the service provider with information about their income and assets to have their MTA calculated. And the reason for this is that how can a service provider accept a payment from you which restricts how much they can get if they don't know what you've got? So that's why it's a really interesting rule. So if they don't know, then the rule doesn't apply to you. The rule also only applies in the first 28 days, but you can pay whatever you like from day 29 onwards if it does apply. So why $48,500? Well, it's the government's way of saying that's probably how much you should leave yourself as a cash reserve, and don't go too hard making any payments towards the RAD. And it's also sort of, putting the brakes on in case, once you've overpaid it, you might not be able to access it to fund your expenses outside. So it's just giving you a chance just to really have a think about what might be an appropriate payment to make. So if we apply this to Manny, the interesting thing here is that his assets include a home worth $300,000 and cash worth $200,000. Now, when applying the $48,500 rule, the home is capped, obviously at $165,000 when calculating his MTA, but the full value of $300,000 is actually assessed when determining the rule. So this is quite interesting. Even though he hasn't sold his home or he can't access the funds, the full value of the home is assessable when determining the $48,500 rule. So that means if we added that all up and took away the $48,500, the most he could pay in the first 28 days is actually $451,500, which is obviously more than he's got in the bank account. But as I said, we use the full value of the home in this case. So it just means that with this one, if he really wanted to, he could pay $180,000 towards the RAD in the first 28 days and have $20,000 left in a bank account and still satisfy the $48,500 rule. Okay, so last but not least, assessable income and asset questions. So next one, we've got updating Centrelink information. So this one we have is, can the SA 457 form be used to update income and asset information at Centrelink DBA? Now, the short answer is yes, it can, but remember these forms can take 8 to 12 weeks to process. So if the update to circumstances is going to impact the Centrelink payment and the change is material, then you might want to update directly through Centrelink using the portal or other means. So this information will be used if you say in question 72 that you don't want to use your information because it's changed, and you select yes and then fill in the rest of your income and asset details on the SA 457 form. So it will make it to Centrelink eventually to have your payments and means tested fees calculated correctly. But just remember, the onus is on the client to update Centrelink DVA within 14 days if there's a material change to their circumstances. Now, that's just one of the criteria of getting an income support payment. Okay, so question 15, assessing funeral bonds. So how are funeral bonds assessed under the Centrelink DVA income and asset test? So the reason why we've included this one is it's always a strategy to reduce assessable assets by purchasing a funeral bond. So we're just, rehashing the rules to make sure that we get the exemption if it applies. So what is an exempt funeral bond? Well, essentially it's a funeral investment that matures on death. It does not relate to a funeral where any expenses have already been paid in advance. So that might include purchase of a cemetery plot. Is not able to be redeemed, and the investment is less than the exempt funeral bond limit, which is currently $13,000 per person, or combined if it's a joint funeral investment. So if you have a couple, don't combine it because it's only $13,000 per bond. You might want to do $13,000 each because it's then per person. You can invest across a maximum of 2 investments, and it remains exempt even if the value of the bond grows more than the exemption limit, because it's allowing for growth and indexation and the cost the fact that funeral costs can go up. Now, if you were to purchase a funeral bond over the limit of $13,000, then you do not get any exemption limit. The full amount is assessed as a deemed investment. So just be careful when you're purchasing the amounts that it's not more than $13,000 per person, or joint if combined. Okay, so if the funeral costs are more than the bond limit, then you might want to look at prepaying for funeral expenses because there's no limit supply there. But just remember, prepaid expenses are only exempt if it's a contracted payment and no additional services are required beyond those covered in the contract. So you could pay up to $50,000 and have everything included as part of your contract. The other thing is that payment cannot be refunded unless you move outside the funeral area. So it's just to sort of say you can pay more, but you're contracted to a particular funeral service provider, and there's always the risk that they could go bankrupt and you lose your funds. Other things to note, the burial plots are also exempt assets at no limit supply. So that could include a family mausoleum, crypt or burial vault, but you can't have a cemetery plot and a funeral bond. So you can't have exemptions on both. So just to point that one out. Assessing whole of life policies. Now this is luckily, this is just more of a very quick overview of whole of life, because we are having some clients who have these policies. They're no longer around to be purchased anew, but obviously we still have some old policies in place. So in this case, a whole of life policy. So Nathan, in this case, he's a full age pensioner in permanent care, and he has a whole of life policy maturing in 6 months' time. So the maturity value is $85,000, which includes bonuses of $71,000, and the current surrender value is $70,000. So this is what he's got. So how is it assessed now, and how is it assessed at maturity? Well, before maturity, it's only the surrender value for a life insurance policy. So if he was to cancel it today, then it's just the surrender value of $70,000. No assessable income from a insurance, whole of life insurance policy, just the surrender value under the assets test. However, for these policies at maturity, things change quite a bit. At maturity, the maturity proceeds, so in this case, $85,000, regardless of whether he cashes it out or leaves it there, becomes assessed as a financial investment. But if he cashes it out and spends it, then obviously it's going to be assessed depending upon how it's spent under the income and asset test. Unfortunately, the bonuses are assessed under the income for 12 months. So the bonuses in this case are actually $70,000. So that means that Nathan's going to lose his age pension under the income test, and his means tested fee might increase. So this could be quite devastating for Nathan, that due to this assessment, that for 12 months he won't be eligible for the age pension due to the assessment of those bonuses. So what could he do? Well, he could gift the policy before the maturity date and reassign ownership. So this is going to obviously attract deprivation. So the deeming is going to be based on the surrender value less any gifting limits for 5 years. So remember, the surrender value is $70,000. So that means that excess gifting of $60,000 will apply. So that means deemed income is going to be assessed, and then again, obviously the surrender value, and deemed income of $1,950 for the next 5 years. So that might be a better solution, because it's going to impact his age pension less, but you'd have to consider the impact on the person who's inheriting the bond, because it's going to be assessed at maturity above for that person. So just bearing that one in mind, but that could be a solution in this situation. Lastly, the last question, we have creating a granny flat right. So we're not talking about how we create them here. We're just assuming that one has been created. So John, in this case, he's age 82. He created a granny flat right 6 months ago by transferring the title of his home worth $1 million to his son. His other assets outside of the home are $150,000 in cash, and he now needs to move into permanent aged care. So the question we have here is, how is the granny flat right assessed for aged care fee purposes? Okay, so even if he was a homeowner for Centrelink or DDA purposes when the granny flat right was created, because remember, if it's more than the difference between the non-homeowner and homeowner thresholds at the time, which is currently $207,000, then that determines whether you're assessed as a homeowner or not. So he would have been assessed as a homeowner for Centrelink DDA purposes. However, he's assessed as a non-homeowner for aged care fee purposes. So that means that for granny flat arrangements, we're not looking at the cap value of the home applying when determining fees. So really important distinction there. However, how are we going to assess the granny flat right going forward for aged care fees and age pension will depend upon a variety of factors. So it's going to have a look at, well, when the assessment of the right is going to depend upon whether a move to aged care was expected at the time the granny flat right was created. So let's have a look. If the granny flat right was created more than 5 years ago, then there's no deprivation and the granny flat right ceases to exist. So that's just because it's outside the 5-year deprivation period for gifting. If the granny flat right was created less than 5 years ago and the move was not expected, then no deprivation and the granny flat right ceases to exist. So he could have created it 6 months ago and was fine, and then he fell down the stairs, both hips, got blood poisoning in hospital, and essentially had major problems and had to go from hospital to the aged care home. So in that particular case, he was fine at age 82 at the time, but unfortunately the circumstances that he ended up in aged care was the reason why he needed to move in, not health conditions that were existent at the time the right was created. Okay, so that means that no deprivation, granny flat right ceases to exist. If the granny flat right was created less than 5 years ago and the move was expected, then deprivation applies on the full value of the granny flat right from the date created, less gifting limits. Now, this is rather subjective, obviously, because you'd have to prove that the condition that really meant you had to go into aged care was not existent at the time, because we're saying that you can't give all your assets away and then go into aged care 6 months later when technically you should have gone into aged care 6 months when the granny flat right was created. So in this case, the home was worth quite a bit, so 1 million. So that means that deprivation will apply on the full amount less any gifting limits. So it could be 990,000 would be the deprivation. So that would apply from 6 months ago. So it would have 4.5 years to go. And that means that the full amount of deprivation will be assessed when calculating aged care fees and Centrelink age pension benefits. So really have to think about, when they are creating these rights, just to have a think about, well, would a move to aged care be expected at the time, or is it possible? Because you might get caught up in this, 6 to 12 months later if a move into aged care, does need to occur. Okay, so to start us in of our webinar today, if you do have any extra questions, please write them in the chat box, and then we'll do a webinar Q&A based on Q&A. That's always an interesting document. For our toolkit subscribers, the webinars will be available under the technical library and training past webinars, so you can review the webinar again at your leisure. If you have any other questions, or you're not a toolkit subscriber and you'd like more information on our services, please give us a call on the number at the bottom of the screen, or send us an email at info@agedcaresteps.com.au. All right, thank you everyone for attending, and have a good day.